Investors all across the lower mainland of British Columbia are losing massive amounts of money. What happened? So for anybody that bought a property at the peak of the market, let's say in 2021 or 2022, they bought their properties, whether they were resale or directly from a developer, at completely inflated prices due to how crazy the market was. Now, many of those investors are finding themselves today needing to offload those properties because they are simply not cash flowing. This means that not only are they losing money each and every month, but they're also going to sell those properties sometimes at massive losses. Now, this is a very real problem that so many are dealing with, not only in the city of Surrey, BC, but also across the entire lower mainland. So in today's video, I'm going to share with you an interview that I did with Jimmy Lee Tang of Achieve CPAs. Jimmy and I had a really great discussion, about a solution that is going to be very palatable for many investors who need to sell, investors who are bleeding money monthly, and investors who are taking massive losses on the resale price of their property, but a solution that's going to help them come out ahead. This is a tactic and a conversation that really only very savvy real estate investors know, but one that can help everybody who might find themselves in this situation. The tactics I'm going to share with you in this video today are going to help minimize how much you have to lose when you sell your property. It's going to give you a long-term strategy well into the future, and best of yet, it's going to help anybody who needs to sell right now or wants to sell right now recoup their losses. So if that all sounds good, let's get into it right now.
You only get one chance to buy or sell your next home. Let's get it right.
This whole premise of how we can help investors and people in this situation where they are just losing money, whether it's monthly or whether it is the loss they're going to take from selling and buying at a way higher price than maybe they should have ever had of, really came from somebody that reached out to me inquiring about helping them sell their rental property in Surrey. Now, I went to go take a look at this property and was very straightforward with this person on the phone. In fact, I said, look, if you're not prepared to sell it in and around this price, you are going to be in a sea of other listings available. At the time, as an example, in the North Surrey area, Guildford, Whalley, all the areas in North Surrey, there was about 850 condominium units on the market at the time, and 750 of those were in the Whalley neighborhood themselves. There was so much competition, and there still is so much competition, that just simply listing your home for what you need or trying not to lose any money is a losing battle. And you've seen this pop up on the news, in fact, recently, that real estate professionals all over the lower mainland are actually turning down the opportunity to try and help people sell their properties because those people, they're not unfortunately realistic with what they want to sell for. They have a want of what they want to sell for because they want to try and get their money out of the property, but that's nowhere near what buyers' perceptions are of what the actual property is worth. And this is a massive discrepancy. So anyways, after being assured by this gentleman that, he was going to be reasonable, we went out and took a look at the property. And what I had learned is he had bought from a developer. He had paid GST on this new property. He had paid property transfer tax on this new property. So he's already got all these taxes kind of built into his purchase. But not only that, he bought at an inflated rate, a developer's rate. Oftentimes new properties sell for more because they're new and everything's brand new in them. And so you probably should pay a little bit more. But sometimes too, the prices are completely inflated because the developers, they could get away with it at the time. So this gentleman was probably going to be underwater by almost $100,000 from what he paid for this property after all the fees and whatnot were taken into account. So obviously this doesn't feel good, right? Nobody wants to take a loss like that, but that's the reality of today's market. Now, he could have listed his property for what he had put into it, but the problem with that was there's nobody in their right mind that would ever give him the money for it, right? Nobody's ever going to pay him what he wants out of it. So this was problem number one, but he went on to tell me that since mortgage rates had gone up and, the cost of living and really carrying a rental property, everything has gone up. So even strata fees, he was a little surprised by what the strata fees actually turned out to be, that he had, made the decision to rent out the unit, but his monthly carrying cost was exceeding what his rent was by about $1,500 per month. That's crazy, right? I want you to think about that. You want to sell your property, you're $100,000 underwater on it, and you are burning $1,500 a month. So what do? Right? Like, do you hold on for another year, another 2 years, another 3 years, another four, five? How long are we going to be in a market like this, in the condominium market, especially in the North Surrey area, as an example? So do you hold on to it for longer, hoping the market's going to come back at some point, which it will at some point. Nobody knows when, but it will come back. But how long do you do that? As well as how long do you burn $1,500 a month? And that's not a little bit of money, right? Like that's a decent amount. In trying to help this gentleman, which I feel really bad for. I mean, that's a terrible situation to be in. And that's one of the number one reasons that we recommend to people. We've done so many videos about this on our YouTube channel. So you can, check these videos out. You can find them very easily on our channel about why we do not recommend to buy new construction. And there's a million reasons around that. But we typically, tell our clients to stay away from new construction unless they meet very specific criteria. So if you're curious about that very specific criteria, book a call with me and my team. If you want to buy a property in Surrey or any of the surrounding municipalities and you want really good advice, direct advice, and advice that's going to help you and keep you out of situations like we're talking about in today's video, you can go ahead and book a call with us in the description below. I guess before I forget as well, worth mentioning, there is a link in the description as well for 21 grants and incentives for home buyers like yourself watching this, or home owners. There's free money out there, guys, so you might as well take advantage of it. So be sure to check that out in the description below. I knew there was a solution to this problem, and I wanted to try and help this gentleman figure it out to make it as palatable as possible. And in doing so, I reached out to my good friend who is a certified professional accountant. And I've had the good fortune of knowing Jimmy Lee Tang with Achieve CPAs. He just moved over there. He's been in the business, I believe, since 2008. He's had his own practice and just joined up and bought into to join forces with the good people at Achieve CPAs. One of the smartest people I know. I've had the good fortune of helping him buy and sell real estate, and he's had the good fortune, well, I don't know, we can ask him if it's good fortune, of helping me with my taxes. And he's absolutely brilliant with this sort of stuff. So I knew there was a solution here, and I wanted to talk to him about 3 key points for this video today to help people that might be stuck in a similar situation to the gentleman in the story that I described, to help them be successful and figure out a path so they can stop burning money. They can get out of their bad investment. That can happen. You can do a bad investment in real estate, and people have found themselves in that situation. So I wanted to have a conversation with them around what we could do to stop the burn, make sure that they are recovering as much money as possible, and introduce you to this little known trick that only really savvy investors know, but it's something you're definitely going to want to pay attention to. So we really cover 3 topics in this video with Jimmy. The first one is covering current expenses. So what is going on with your rental in terms of financial outlay? What are you spending on this each month, and how can you recover some of those expenses so you can offset the burn, offset the problem of what you're experiencing right now? So we talk a little bit about that. We're also going to talk about the real estate fees. Now, there's all different sorts of business models for selling a home out there, but oftentimes it costs a percentage of what the total sale price is of the property, which can add up, right? So we want to know what we could do to help minimize that. And I'm not talking about trying to find the lowest fee for service. I mean, certainly you could do that if that's what's important to you. You need to understand what you're getting for that fee for service and the results that you can expect. But hey, look, this video is not about fee for services on real estate commissions today. Lots of videos on YouTube about that. You can get into those. But how do you recover some of those expenses that you are going to pay to transact the property to somebody else, including real estate, lawyer fees, all that sort of thing? And the last thing that we're going to introduce, well, tell you what, I'll tell you about that towards the end. Let's jump into the first 2, and then I'll let you in on the big reveal towards the end of the video. So here's what Jimmy had to say about current expenses, about what people are shelling out each and every month, whether they're making money or not, when they are renting out their property.
Yeah, so current period expenses are anything that you incur in the current tax year to maintain, keep running this rental property. So some of the obvious ones are, your strata fees, your insurance annually on the property, your property taxes. Some of the less obvious ones would be your interest on the mortgage. So a lot of people are always thinking about the mortgage as a single number containing the principal and the interest component. And then when they get to doing their tax return, they forget that the interest component is tax deductible. So while the entire mortgage payment is not tax deductible, the interest part of it is. And on every every year your bank will send you a mortgage statement that covers the entire calendar year. And on that mortgage statement, they will specify exactly how much interest was paid in the year. And that's the dollar amount that you can deduct against the income that you've earned. So that'll reduce your tax burden. Other things that would reduce your tax burden, if you have like a detached home and there's like landscaping, cutting the lawn and all those kind of things, you can deduct that as well too. If you hire an accountant to help you prepare your tax return, that's also a tax deductible expense. If you've borrowed money outside of your mortgage, let's say maybe you have a separate line of credit that you've been dipping into to finance the ongoing expenses. Well, the interest component on the portion of your line of credit that was used for the property, that's also interest as well. And you can deduct that against the rental property income. So there's lots of little things like that that people tend to forget about because it's not an immediate and direct expense.
So this is good news, right? We know that every single dollar that goes out that is able to be written off, we can try and recover some of that money. So that's phenomenal. Now, the next thing that Jimmy and I get into in this interview, and the full interview is going to be linked in the description of this video. So if you want to watch the whole thing, it's certainly there. I just wanted to give it to you in snippets today. But the next piece deals with real estate commissions. So what happens with real estate commissions when you sell a tenanted property, and how can you recover some of that expense?
So when you sell a property, you would report the sale on your personal tax return, and there's a box for proceeds of sale, which of course is just the sale price. There's a box for adjusted cost base. Now, adjusted cost base is, some people think it's just your purchase price, but there's more to it because your adjusted cost base is not just your purchase price, but you also have to add in your purchase costs. So if it was a brand new property, you're adding in the GST. Whether it's a new or existing property, you got property transfer taxes. So that becomes part of your purchase price. If you hired a lawyer to help you with the conveyance on the purchase, your legal fees become part of your purchase price. So anything that you incurred as a cost to acquire the property becomes part of your adjusted tax cost. So your tax cost is higher than just your purchase price. So, and if you include all of that, it'll reduce your capital gain, obviously, right? And then there's another box on your tax return for something called outlays. And outlays are your costs in respect of selling the property. So any fees incurred for selling the property, like legal fees, realtor fees, maybe you paid for some staging costs, and your realtor didn't pay for that, maybe you paid for it, then, your staging costs will become part of your outlays as well. So anything that you paid in connection with the sale would then be deductible against your net sales proceeds.
Now, Ginny touched on what's called a capital gain, and we were talking about real estate expenses in this case, but you can only write off a real estate expense if you have a capital gain. You've sold for more than what you bought for. You can't write off this real estate commission if you don't have a capital gain to offset it to. So we're going to introduce you now to the big reveal. And this is introducing you to a term, the term is capital losses. So what is a capital loss? Well, a capital loss effectively is the opposite of a capital gain. It means you bought something and you bought it as an investment and you're selling it for less than what you originally paid for it. Investopedia defines a capital loss is a financial loss that is incurred when a capital asset is sold for less than its original purchase price. So why is a capital loss so important to what we're talking about? Well, I want you to hear Ginny's words on this and the discussion that ensues around a capital loss and what your options are if you have one.
If you're in the unfortunate position where you're selling ultimately at a loss as well, you end up with a capital loss. Now, a capital loss is not immediately deductible against your tax return. It is only deductible against other capital gains on your tax return for the same year. So maybe in that year, if you've got some capital gains and now you'll sell that property and then you can also utilize that loss against those capital gains. But if you don't have any other capital gains in the same calendar year, your capital loss does carry forward. So you can use that capital loss against future capital gains. So it's not an entirely wasted loss. You do get to to move it along to, I think it's up to 20 years or so, which is, a long time, right?
Yeah. Well, and that's the big piece that I want people to really take away from this. So I think a lot of people really understand what a capital gain is, but they don't necessarily understand a capital loss. And effectively, it's just the opposite of a gain, right?
Yeah.
But that capital loss, that's not necessarily gone forever. So I want to give an example, and I want you to kind of correct me if I'm wrong. So if I had a condominium that I had purchased, and after everything's said and done, let's say I have to sell it for $100,000 less than what I'm into it for, that would represent effectively, or just for ease of conversation, let's say that was a $100,000 capital loss.
Mhm.
Now, if that carries forward into the future, the only way that I can benefit from that is I have to have a capital gain, right? That means I have to make money on another investment somewhere to be able to use that capital loss to offset it. But here's the thing I don't think people really think about. Let's say you've got investments in, whatever you've got, right? Let's say you've got some stocks and some bonds and all these
Yep.
different things that, a lot of people have different irons in the fire. And let's say you get to a point where next year you had a $10,000 capital gain. Well, you can offset that $10,000 capital gain with a portion of that $100,000 capital loss, meaning you still have $90,000 of a capital loss. You've offset your current capital gain. So it's like it didn't exist. And you still have that $90,000 to carry over into year 2, year 3, year 4. So a lot of people, I think, don't appreciate that, while they're burning cash monthly, losing money because their rent on these properties simply isn't covering all of their expenses, there is a mechanism in using that capital loss to recover that money over the long term. You just don't get to realize it today. Is that a fair statement?
Yeah, that is a fair statement. And Darren, I'll also add to it too that, if you have capital gains in the previous 3 tax years, you can carry back that capital loss 3 years as well. So, we're into 2025 right now. And by the end of the year, you sell your property, you've got a capital loss. When you go to file your 2025 tax return, you can look backwards in time up to 2024, 23, and 2022. And if you have any capital gains in any of those 3 previous years, you can carry back your capital loss to those 3 years and apply your capital loss immediately against those 3 years. So that way you can then, recover some of the taxes that you would have paid on your capital gain in those 3 previous years, right? So yeah, you can carry it back 3 years, but you could also carry it forward 20, right?
That's incredible. So we can go back in time and even get money back from other things.
So understanding capital losses is the key for investors who need to get out of their rental properties and want to get out right away. So just to recap, we covered 3 main points in today's video. Point 1, you can write off current expenses tied to your investment property. Point 2, if you're selling costs can reduce any capital gains. And the big one, if you're selling at a loss, that capital loss can actually save you money on future tax bills. This isn't just about taking a loss, it's about turning that loss into future opportunity. You might be taking money out of your pocket today, but you're actually putting money in your pockets in the future. You're paying your future self against any increases that you might have in capital gains in the future over a long course of time. Instead of holding on to a sinking ship, you now know how to cut your losses and how to come out ahead. So what should you do from this point on if you are someone that's in this position? Well, number 1, you want to talk to a person like Jimmy. Jimmy's information is linked below in this video, or talk to your own CPA and see what your options are for anything that you can write off with your property, and make sure you have a robust discussion around capital losses and apply that to where you think you might be achieving capital gains in the future. Look, if you're a real estate investor, you're likely going to be investing in things for years to come, whether that's real estate or something else. So having that capital loss to either carry forward or even look back into the future, as Jimmy had mentioned, is a really big deal. This is a strategic move, not just a mistake. I also want you to drop a comment down in the comment box below. I want you to let me know if I helped open your eyes to a solution that you never knew might be available. I'm especially interested about the whole capital loss conversation. I read every comment and try to respond to them, so I'd be curious if you learned something today. And of course, if you're someone in the Surrey or surrounding municipalities and you're finding yourself in this situation, and this is a strategy and a solution to help you stop the burn and get out and maybe find different opportunity in different investments, maybe outside of real estate, make sure you hit us up and we'd love to chat with you. So you can find our contact information in the description of this video, and we would love to set you up with a plan to try and help you sell your home for the absolute most that the market will bear right now, but also help you actually get it done, because there just simply is so many properties that are simply sitting on the market. I want to give a special thanks to Jimmy for helping me in today's video. This is going to help people get from stuck to strategic in terms of recovering some of that money that they may lose and actually help them move on with their lives. Definitely recommend reaching out to Jimmy. You, of course, are always going to want to get your own tax advice. So this is a general video, doesn't necessarily apply to everybody. So you're going to want to get your own advice to your own unique situation. And I want to make sure you have access to something I mentioned earlier in the video, because there is very key reasons why we recommend to our clients to never buy new construction. And we've done many videos on this on our YouTube channel. You could find them, but our favorite video and our most popular one that really sheds light on exactly why we tell people that, well, it's coming up next, and I hope you'll join me over there. Thanks for watching.
Surrey BC pre-sales are in huge trouble. You see, back in 2021, the real estate market was absolutely booming. Call it the COVID rebound, but you could do no wrong in real estate. You had high demand, ultra low mortgage rates, and escalating prices, a perfect environment to buy a home at the time. But then all of a sudden one day, boom.